Alrighty. Thank you so much for being here. We are on the second homebuyer series class, and today we have our local lender here, loan officer Logan Caswell. And she has this beautiful slide she's going to go over with us today. So, today we're going to learn all about home loans. And so, if you're watching the recording, you can reach out to us with any questions that you have after the slides. So, go ahead and introduce yourself, Logan. How long you've been doing this, and tell us what your favorite thing is about giving and helping people with home loans.
Yeah, thank you so much for inviting me. It sounds a little nerdy, but I do love talking about this homes and home loans. And I'm Logan Caswell of Cross Country Mortgage. My office is in Old Town Eureka. I've been a resident of Humboldt for about 15 years now. I moved here after graduating college and just fell in love in it, so I never left. But I spent 20 years in the service industry. And then it was kind of around the COVID time. I decided I was ready for a change. And so I kind of fell into the mortgage industry, to be quite honest. It was kind of a friend of a friend. And I just discovered something that I'm very passionate about. It's a really good combination of numbers and peopling, and every person, every scenario is almost like a little puzzle. So it's something that I discovered I'm very passionate about. I also, to be totally honest, I never thought that I would own a home. And through being in this industry, it taught me so much about just kind of financial literacy and home ownership. And 2 years ago, I was able to buy my first home. So I kind of joke, not joke, that if I can do it, anyone can do it. But I know firsthand how much it's changed my life. And so that's really what I'm passionate about, is helping people become homeowners. Because the reality is, for most people, the first step towards wealth is home ownership. A crazy stat is that the average net wealth, or the median, excuse me, so kind of taking out the outliers, but the median net wealth of a renter is $10,000, and the median net wealth of a homeowner is $430,000. And that is a huge difference. And it's homeownership that makes that difference for most people. Because at the end of the day, owning your home is kind of forcing you to save for your future. It's You're going to pay to live somewhere, so why not pay into your future pocket, is kind of my idea. And one thing that I really fell in love with this industry is that finances can be so intimidating. I know that I personally I was in my early 20s and made some bad decisions, and my credit score got tanked. And then I spent a lot of my early adulthood just kind of being stressed by it and not acknowledging it. And I wasn't until I got into this industry that I learned that your credit score it's not a reflection of you as a person. It's really just a game, and they don't teach us how to play. So I was able to learn some of the rules, improve my credit, and yeah, buy my first house. So
Wow.
just learning kind of little tips and tricks, and then overall, the value of homeownership has been really life changing. So,
That was great. A lot of good tidbits there. Love that. So, thank you
I
so
did,
much for joining us.
yeah,
We might get people jumping on, but it is recorded, so we'll be posting it as well. So, you can go ahead and get started with your slides. Let's see what you got to share. I'm excited.
perfect. Yeah, I'll jump in here. Um, and so, my first slide just is the home loan process. That's what I'm going to go over. My objectives today are: the first step is just why buy. It's kind of something that a lot of us know or have been told, that you should own a home, or it's a goal of a lot of people, home ownership is. And so the first thing I'm going to go over is why. I say a lot, like, wrap some numbers around that. Like, let's take this idea and make it achievable. And to make it achievable, you really have to put numbers to a lot of these situations, because at the end of the day, owning your home is a financial investment. And so let's kind of dive into the financial aspect of it. I'll also go over the process and the people you'll meet in this. It is it is an emotional experience buying a house. For most people, buying a house is the biggest investment that they're going to make in their life. And it does come with, I'd be lying if I didn't tell you that it comes with a lot of emotions. It can be really exciting. It can be really scary. It's most likely will be all of those things wrapped up. And so having a good team is a really, really important part of the process, because I can't imagine doing this without a good team. It would just add so much more stress. Next, I'll go through the steps of a pre-approval, which is a really important part of this process, because the pre-approval essentially gives you your budget. It allows you to find kind of what range your purchasing power is, so that when you do go out to look at houses, you know what you can afford and what range to look at. Next, I'll go over credit and some common loan products. There really is a loan product out there for everyone. It's not one size fits all. And then just touch on the home buying process and the escrow process as well, kind of an overview of that, and then I'll answer any questions.
Perfect.
So the first question that I always ask is why buy a home? It's there are three main benefits to buying a home. One of them, or two of them, are financial. One of them is just kind of a life, but pride of ownership is a big one, meaning when you rent, you're renting someone else's home. So at the end of the day, if they decide that they don't want to rent that home anymore, you have to move, and you don't necessarily get to decide. Maybe they don't allow pets, or maybe you can't paint it any color you want. And so when you do own your home, all of those choices become yours, and it comes with a pride of ownership that, to be totally honest, I say this all the time, and I've said this for years in my industry, but until I owned my home, I didn't really understand this one. It's kind of a silly story, but my partner and I bought our house, and he immediately went out and bought some New Balances, because he realized that we have a lawn that he has to mow, and it kind of just changed his. It took some chores that before maybe weren't so enjoyable, and because you own it and the improvements you make are benefiting yourself, there really is a feeling to that. And that's the pride of ownership. So if you want pets, if you want a purple house, all of these things are up to you. And so that's one really big benefit of home ownership. The next benefit is there's a big tax benefit to owning your home. This one is a little bit hard to wrap your mind around, but I'll try to give some simple numbers to kind of demonstrate what this is. But a big tax benefit is that you will be allowed to write off any mortgage interest you can deduct on your taxes. And again, before being in this industry, deductions on taxes, like, what does that mean? Taxes are already so confusing, but essentially a simple way to think about it is, say you have $100,000 in income. So when you go to pay your taxes, you pay taxes on $100,000 of income. And so by being able to deduct your mortgage interest, say you pay $20,000 in mortgage interest, because home loans, and actually all loans, the way they work is it's kind of an inverse curve like this. So at the beginning, you're paying a lot of mortgage interest and very little principal. And then as the term of the loan goes by, it switches, so that by the end, you're paying mostly principal and hardly any interest. And so that is a little scary. Interest is always scary, but the benefit of that is that at the beginning of the loan, when you're paying a lot in mortgage interest, you can actually write that off. And so what that means is, when you go to pay your taxes, instead of paying taxes on $100,000, you can deduct that mortgage interest. So you can deduct $20,000. So now you're only paying taxes on $80,000. And there's a number to that. So there's a savings. And when I meet with all my clients, we go over their specific scenario, because one, I'm not a tax professional, but everyone's income is different and tax rate is different. And so, but we're able to come up with a number. So in that scenario, that would probably be about $200 a month that you're saving in the amount of taxes that you'll have to pay overall. So that is a huge benefit. The other main financial benefit of homeownership, and this is the big one, is appreciation. So we use the word appreciation and equity a lot in our industry. And I like to think of it as equity is the ownership that you have in your home. And so I think about it as if I turned around and sold my home tomorrow, after I paid off the bank and after I paid off the fees and after I paid off everything, what is the amount of the check that I would receive for selling my home? And that's the amount of equity that I have in the home. So, how much would I make from the sale of my home is an easy way to think about that. And appreciation is a big one. So, appreciation just means that your house gains value over time. And so that number, it's homeownership is an investment. So that number is can fluctuate a pretty conservative. It's 3 to 4% a year. Appreciation is pretty conservative, meaning some years it'll be more, some years it'll be a little less, because homeownership is a long-term investment. But that means that over each year, over year, your house will gain in value. In the example I have up on this slide here, it's a purchase price of $400,000. And this is just based on, so this, in this example, this is not taking into account any sweat equity, like any improvements that you made to your home. This is not taking into account your principal, any principal reductions you did. This is just looking at appreciation, meaning how much your home has gained in value based on kind of what the market's doing. So in this example, they bought their house for 400,000. They lived in it for 10 years. And then their house was worth 653 and some change thousand. And so that's a 200, a little over $250,000 that they gained just from living in their home and it gaining value. And so going back to kind of that statistic I said at the beginning, for most people, saving $250,000 in a 10-year period is really, really hard. It's for a lot of people, it's the reality is life is expensive. Things happen. We have certain expenses in our life that are unavoidable. And so for a lot of people, saving is really, really hard. And so by your home just gaining value, for this, it was a couple, but they were able to save $250,000 in 10 years just from their house gaining value. And so that's really, when we talk about the benefit of owning your home, this is really the benefit that people think about.
Right. And I just think about my clients who bought their home like in the 80s and are selling them now. If we buy now, that could be us, 40 years from now, where because house prices are just, everything's going up and up. So,
100%. And it's not only gaining wealth, but it's generational wealth. For a lot of people, this is the wealth that they're going to pass down to their children. I
right.
know my grandparents bought a house in Marin, right outside of San Francisco, in 1959 for $10,000. And then they lived in that home until they were 100. And that, when they passed away, that house was worth a lot more than $10,000. They
Right.
were a very good example of gaining that appreciation over time.
Hmm.
And
That's a good
so,
one.
kind of moving on to going back to building our team.
Hey, Gerald, thanks for joining.
Thank you for joining. So going back to building your team, and this again is, I think that there's so many things about the home buying process that a lot of people, it's not something that we do every day. Like most people don't, they'll maybe buy one, maybe two homes in their entire life. And so the process is not something they do every day. And so not knowing the steps and not knowing, that's very common. Like I would say that is more common to want to learn about the steps than to be an expert at this. But in saying that, that's why it's so important to find a team so you can hire in your experts, because it's a process. Like it's when you put an offer in on a house, for example, it's like Bridget, how many pages are in the contract? It's
17.
17-page legally binding contract. Uh, it's a lot. And so having someone that is on your team and is going to go to bat for you and have your back is so important. So that kind of sums up in my mind your real estate agent. They're really going to be there. Not only will they know the local market, have negotiating skills, but I personally think their biggest role is just to be there for you every step of the way, because a lot of this, you will have a lot of questions. There are a lot of unknowns. There are a lot of emotions that come with it. So having someone that you trust on your team is hugely important in this. I even am in the industry. I do home loans every day. And if I bought or sold my house, I would 100% use a real estate agent, because it's, like I said, it's a binding contract. It's not something that I want to become an expert in. So I'm going to rely on an expert. The next player is going to be your loan officer. So a mortgage loan officer is someone either working for a bank, or I work for Cross Country. We're a direct lender. And so someone licensed, when I'm licensed in the state of California to do mortgages. And another really important is the relationship between your lender and your realtor, because there's a lot of steps in this process that kind of overlap between their two jobs. And so making sure that they're on the same page and have great communication is another important thing.
Yeah.
The next player is going to be your escrow or title officer. Around here in Humboldt County, we have two great, Fidelity and Humboldt Land and Title. We have a ton of great escrow officers, but the escrow officer's role is, I think of it as kind of a middleman between the seller and the buyer. And it's really there to protect all parties involved. And a big part of what they do is they do a lot of the digging, a lot of the kind of legal looking into the home to make sure that, one, the seller has the legal right to sell the home. So making sure there's no liens on the property, all those types of things that, again, I'm not trying to be an expert in finding title liens, because a lot of it is the amount of research they'll do on the property that you're interested in buying is mind blowing sometimes. But that's really to protect you, because ultimately, if you own this home for 10 years and someone comes out of the woodwork and says, hey, I have a lien on this property, I want to go back to my escrow officer and say, there are title insurances that come with it, and it's really just to protect you for not only during the home buying process, but for the entire length of the time you own the home. They will also help with signing documents. They collect your earnest money deposit. And at the very end of the day, the seller gives escrow the keys, and the buyer gives escrow the down payment and the closing costs, and then escrow. So they really do protect both sides.
Mm-hmm. Yeah, they have a fiduciary duty to both the buyer and the seller. So I like, that everything that they do is based off of contracts, and both parties have to sign the documents that they are going by. So if one party doesn't sign, the escrow can't complete that assignment. So they want to make sure both parties agree, and then they can execute what the parties have agreed on.
Lots of documents to sign in this process.
Hmm.
The next players are going to be the home inspectors. And two things that happen right away in the home buying process are home inspections and appraisal. And the appraisal is required from any lender. Anytime you get a home loan, it's an appraiser's required. And then the inspections are just highly recommended. Because ultimately, again, it's a huge investment. And so you want to be aware of what you're investing in. And that's where the inspectors really help you. And so they're similar in what they do, but they actually have very, very different jobs. The inspectors' jobs are to go out and tell you anything that could or will be wrong with the property. It's honestly, I describe it as a gut punch, because a lot of times you'll get the inspections back and it's a little intimidating. It's
Yeah.
pages and pages of you have to maintain homes. And so a lot of it, sometimes you'll see some delayed maintenance, but it also can bring up big issues that maybe you can't see on the surface. And so it's really important to get these done, because say for a roof inspection, say you're buying this house and to the seller's knowledge, the roof is in great shape, and you get a roof inspection and it says, you know what, this roof really has like 3 to 5 years left on it. It's not a deal breaker. You can still buy that house, but then we're going to want to sit down with you and think like, hey, that's kind of a big ticket item. Are you prepared to have that expense in the next 3 to 5 years? Especially here in Humboldt County, we are an extremely moist area. And so for us, water is kind of the biggest threat to a lot of homes. Water damage can really do a lot of damage. It can come in the form of, so roof's a big one because obviously you want to keep the outside moisture from inside your house. So that's a big thing. But and your real estate agent will be able to walk you through the inspections and kind of go over them because I know when I got mine, I felt like I got punched in the stomach.
Yeah.
But I sat down with someone I trusted and they kind of walked me through them. And I like to think of myself as handy, but in reality, I'm not very handy. So once he kind of explained what it was, it made more sense. So that's kind of the inspector's job. And then the appraiser's job is to go out and tell you the value of your home. And a lot of the value in your home is, they call it comparable sales. But essentially, the appraisal will go out, they'll look at, they're going to flag any health and safety hazards. So things to look out for, like exposed wiring, or if say a railing's missing on a deck or something that is a huge health and safety hazard, they will call that out. But their job's different than an inspector. They're not trying to tell you what's wrong or what could go wrong. Their job is to make sure that the value's there. So they're part of the lending process because your lender wants to make sure that you're not buying a house for more than your house is worth. And but like I said, a lot of the value in your home is just, they look at what other like homes in your area are selling for. And so we call them comparable sales, but they'll look at sales in the last 6, sometimes 12 months in your area with similar, like, so say you're buying a 3-bedroom, 2-bath with a garage, they'll look for similar sales in similar neighborhoods and see what that sold for. And that's how a lot of the value of your home comes from. So inspectors and appraisers, it's a similar but very different jobs. Those are 2 of the things that in this process, in the home loan process, that you do pay for outside of escrow. So most of your closing costs and your down payment, you'll pay into escrow at kind of the very end of the process, typically a few days before closing. However, inspections and appraisal, you do have to pay for before closing. The reason being for that is you are not obligated to this until the very end of the process when you sign with a notary. So say you get to the very end of the process and you're thinking, you know what, this is too much, this decision, like, you're not obligated to that. But the inspectors and the appraisers went out and did their job, so they deserve to be paid for their work. And so that's the reason that they're paid outside of escrow. But everything else is paid through escrow at the very end of the process. So
It's kind of,
those are
they're
the
like
main.
third party people that come in, so they have to get paid for their work through that. Yeah. I always tell
Correct.
people that the inspector is for to know what you're getting yourself into, and the appraiser is the eyes and the ears for the lender.
Mm-hmm.
That's kind of how I
100%.
explain it. But Gerald knows about inspections because he had a little pipe leak in the rental that they had. He told me about last time. So,
Oh,
he
no.
gets it.
I had and I met an inspector at a mixer earlier this week, and he said, he asked me when the last time I checked to see if I had leaks in my home, and I thought, I don't think never is the answer you want to hear now. But he recommended turning off your water and taking a picture of your meter and then coming back in a half an hour. And if it's changed at all, then you have a leak somewhere, a slow leak.
Okay.
And I thought, oh, goody, one more thing to add to my.
Yeah.
But it is, water is it can do serious damage to property. Um, so the next big thing in the home buying process, or one of the first things, is the pre-approval process. And the reason this is so important is it gives you your purchasing power. So through looking at through going through the pre-approval process, we'll take a look at, I call them my 3 C's, but it's credit, cash, collateral. And I'll explain more what that kind of means. But once we figure out those things, we can start to dial in what your budget is, which will then allow you to go out and start shopping, because ultimately you need to shop to find the house that you want to buy. And it's always so devastating when I have a client who is really eager and they go out and they start shopping, they fall in love with a property only to find out that maybe they don't qualify for that, or maybe the monthly payment's not comfortable for them at that. And then it's kind of devastating when it doesn't work out. So the pre-approval step is always a great first step, because it really allows us to dive into these numbers before going out to shopping and falling in love. So the main 3 things we look at in the pre-qualification or the pre-approval process, we're going to look at your income, your assets, and liabilities. Liability is just a kind of a fancy word for credit. So the first thing we will look at is income. And there's a ton of different income that can be counted. So a few of the main ones, we have W-2 income, self-employment, 1099, Social Security. You can even use alimony. You can use trust income. Basically, if it's income that can be documented, you can use it to buy a home. And that kind of hits on my very first part of the home loan process, that is, I don't want to say sticky, because that has a bad connotation. I am one of those weirdos that I do just love paperwork, but anything that you use in a home loan process, meaning any income, any assets, we're going to need to document it. So I joke that throughout this process, I'm going to ask for every document, and your kitchen sink, and a blood sample, and your firstborn. And there will be moments where you're annoyed at me, because sometimes you think, I already gave you my bank statement. Why do you need another bank statement? And it basically, we just need to document we need to paper trail any dollar that's used towards the transaction. So it's kind of an overview of how the mortgage industry works is, so I work for Cross Country. I'm a direct lender. So when we go through this process, I lend you Cross Country's money. And then how Cross Country makes its money is it groups all of its loans together and sells them to Fannie Mae and Freddie Mac, which are the 2 government-backed entities, and they own a majority of the mortgages in the United States. And so that's kind of how the whole industry works. Excluding, there are some credit unions that portfolio all their loans, meaning they keep on all their debt and all the risk. But most of the mortgage industry works by selling them to investors, Fannie Mae, Freddie Mac. And so ultimately, we have to follow Fannie and Freddie's guidelines. Guidelines are just another word to how to say rules, the rules to loans. But we are following their guidelines because ultimately we need them to invest in these loans. So when I ask for 2 pay stubs and 2 bank statements and this and this and this, I do love paperwork, but it's not because I love paperwork. It's because because Fannie Mae says that this guideline exists, and so we have to follow those. So for a lot of people, it's, I know some old timers too who bought a house before, but it was previous to 2008. That was kind of, I don't know if everyone is aware, but something happened in 2008, and it was a recession, and the whole market crashed, and a lot of it had to do with home loans. And it was essentially all these people got home loans that they didn't really qualify for. There was one called a stated asset, and you could just walk in and say, hey, I make $1 million. And they'd say, okay, sign here. Here's a home loan. Not looking at if they could make that payment or not looking at anything. And so after the crash of 2008, a lot of protections went in. And so it's not like that anymore. We really do document. We want to make sure that you're able to make the payment for the loan. And again, to protect both sides, to protect you and make sure that you're getting into a good situation, and to protect the lender and ultimately the investor. But a big thing that we'll look at, it's called your debt to income ratio. And the reason this is so important in the whole process is that your debt to income ratio kind of ultimately dictates what your purchasing power is going to be. It's and again, going back to the Fannie and Freddie guidelines, loan products have kind of different rules, but in general, we want the debt to income ratio to be 50 or below. And so what your debt to income ratio is, it's your gross income divided by your monthly debt obligations. And so your debt obligations are going to be anything that is on your credit report. So it's going to be car payment, student loans, credit cards, child support, alimony, anything that you pay monthly. It doesn't count things like PG&E or groceries or things that are reoccurring bills but are not on your credit report. We don't have to calculate those in the debt to income ratio. So really just anything that's on your credit report. But a big part of your debt to income ratio is that future mortgage payment. So you're getting a home loan, you're going to have a mortgage payment that is calculated in your debt to income ratio. So say we do all your calculations. We have your income in there, we have your debt in there, we have the new mortgage payment in there. And once we divide those two numbers, your debt to income ratio is too high. It's above 50. We need it at that 50 or below. So the two ways to lower it are to increase your income. And for most people, like, yeah, that would be cool if I could go out next month and make 10,000 extra dollars every month. But for most people, your income is kind of what your income is. And so typically to get that debt to income ratio lower, we have to lower your debt obligation. And again, most people's bills are kind of what they are. So we do that by lowering the future mortgage payment, which in turn lowers the purchase price. And so that's kind of the reason that your debt to income ratio plays a huge role in what you qualify for, your purchasing power. And
Logan,
so it will be the debt to, we call them your ratios, but it will be something that we discuss a lot in the home buying process.
is there certain debts that you might wait to pay off until after you close escrow?
So I always say in this process, if you're going to do anything with your money or anything, just reach out first and ask. Because a lot of the answers, like, so the answer to that is yes and no, which is on a surface, like, that's a very annoying answer. I understand that. Because sometimes we need to pay off debt to qualify for a loan. So that's one option. We want to get to a higher purchase price, we can like say you have a $900 a month car payment, and you decide you're like, it's time for me to buy a home. I'm going to sell my car to qualify for this loan, because then all of a sudden you have 900 more dollars in your debt to income ratio. That difference in your purchase price could be from like 350 to 400,000 that you qualify for. Oftentimes it's like if you have a smaller credit card that has a monthly payment and we just need to eke out a little bit more, we could pay off that credit card to free up that space in your debt to income ratio. However, we will want to be strategic about it, because if you can pay them through escrow, and so then we can exclude it and then you'll pay it through the closing process. Because if you pay off a credit card, and say you close it, you think that's the right thing to do, that can actually have a negative effect on your credit score. So we always just want to be strategic about paying off debts. Also, another reason there's kind of a gray area there is say you're tight on your cash to close, meaning you have $20,000 and that's your down payment and your closing costs, and that's what you're going to bring to the transaction to buy it. And then you go and pay $5,000 to pay off a credit card. Now all of a sudden we're scrambling. Maybe you don't have enough money to close the transaction. So just any piece of those financial, just reach out. There's a strategy and we can talk it over. And
Cool.
yeah, that is always my advice.
Thank you.
The next part of home buying is your assets. So this is when you buy a home, you have your down payment and your closing costs. Together, those are your cash to close. So I think about cash to close as like, how much is the check that you are writing to buy this home? We don't actually write checks anymore. We wire money, but it kind of visualizes it nicely in my mind. Your down payment, depending on the loan product, it can be anywhere as low as 3%. It's for a lot of people that 20% kind of sticks in their mind. The reason being is if you put less than 20% down, you will have mortgage insurance on your, and the name's a little confusing. Mortgage insurance is really to insure for the lender. It's insurance for the lender that if that loan defaults, that they will be paid. Um, but I know like kind of I think it's maybe our grandparents' generation, maybe our parents, it was like you need to save 20%, like it's a bad decision if you don't save 20%, and that's just not really reality anymore. Like they conventional loan, you put 3% down. If you have decent credit and you have a kind of a strong file, mortgage insurance can be as little as $50 or $60 a month. And in a lot of cases, it'll be something we discuss because it obviously is different for different people's goals. But for a lot of people, it makes more sense to pay that $50 or $60 a month until it falls off. And even if you invested that additional money that you would have put, like even if say you have the 20%, if you invested that money, you'd probably get a quicker return on that money, not putting the 20% down. So just another part of when we meet to go over your goals. Because it, like I said, each person is different. And so each scenario is different. And I think of it as a little puzzle because if your goal is to buy a house and live in it for 3 years and then you know you're going to leave the area or whatever, we're going to set that loan up differently than if you came in and you said, hey, this is my forever home. I want to live here for 30 years. There might be different strategies that we have because those are two different financial decisions, obviously. And so assets are one thing we look at because, again, we have to document everything for the process. So not so much in Humboldt County anymore, but there was a time in Humboldt County where there was a lot of cash under a lot of mattresses. And cash is not king in a home loan situation. It's not a deal breaker, but it does, any cash that you're going to use towards the transaction has to be seasoned, meaning we have to see it in your bank account. For most instances, 60 days, 2 months is kind of because you will supply 2 months of bank statements. And so again, just kind of the planning. If you have, because some people, my partner's a cash under the mattress guy. He just feels safer that way. And so, so when we knew we were going to buy a house, we just started depositing it over time so that when we were ready, the amount was in our account and it was seasoned. You can also use retirement investment accounts. You can get a gift for a down payment and closing costs. Basically any money that is, we say sourceable, but anything that you can show a paper trail for, you can essentially use for a home loan. And then a big part of this process is your credit. The reason I say it actually in the scheme of the loan process, it's not like how much money you want to bring in, what your purchasing power is, what your income is. These actually kind of play a bigger role in the home loan process. The reason that credit is such a big part, in my opinion, is that for a lot of people, credit is really intimidating. It's something that they don't teach in school. It's something a lot of us, I know that in my early 20s, I kind of destroyed my credit. And then I was really embarrassed about it for years. And so I just didn't talk about it. I was kind of ashamed. There were these emotions that I had wrapped up in it that I really shouldn't. Like, your credit is not a reflection of who you are as a person. It's a reflection of this game that they created that they don't teach us the rules to play. So in my opinion, like, let's learn the rules. There are a lot of tips and tricks that you can do. And to be honest, I've never seen a credit score that we couldn't make a plan for and improve. And I mean, like in the 400s, getting into the 600s, like big improvements that you can make by some simple steps and some good habits. And so I think in my job, a lot of credit is people come in and they're just scared. They're scared to see their credit. They're scared because of that unknown, I think. And so my opinion is like, let's take it on. Let's take it head on and look at it. And because, for instance, so credit scores range from 300 to 850. Um, your credit score will play a role in what interest rate you qualify for. It will play a role in what loan product you qualify for. So it does play a role in it. Um, but there are simple things that we can do to improve it. For instance, just some good habits to be in. Your uh, the credit bureaus reward you by increasing your score when you keep your utilization below 30%. Meaning, say you have a card with um, $1,000, what am I looking for? Credit line. Uh, and it doesn't mean you can't go out and like buy a plane ticket and raise it up and have little bumps in it. But overall, you want to make sure that you utilize the 30%, 50% is okay, 30% is ideal utilization for cards. Because say you have 3 credit cards and they're all maxed out, that eventually will start to have a negative effect on your score. Another big one for your credit score is just 15% of your entire credit score is your length of credit, meaning how long your credit cards or that credit installment has been opened. I know for me personally, I really resented my student loans. I got them when I was 18 because I was, excuse my language, but young and dumb and didn't know. But one good thing that they've done for me is at this point, they're my longest credit. And so I've been paying them, excuse me, I've been paying them for, I don't know, 18 years, 20 years, holy moly. I've been paying them for a very long time. And they're in good standing. And so at this point, when I pay them off, my score might drop for a little while, actually, because it's my longest length of credit. So one easy thing to do to improve your credit score is you can have someone sign you up as an authorized user on one of their accounts. And for a lot of people, especially if you're younger and you just haven't had credit for a long time, you kind of get stuck in this like plateau in your credit score because what they're looking for, they see that you pay your bills on time, they see that your credit can increase, they see these things, but because of the length of credits not there, it's just kind of going to be time to get up to that next bump. So one tip or trick is to have someone sign you up as an authorized user on their card, and you don't have to have access to the account. They'll send them a card with your name on it, but what that allows you to do essentially is to pick up all the good parts of their credit. And so for a lot of people, like I know when I was younger, I did this with my mom because she had had a card that was open since the dawn of time. And it gave my score an instant 100-point boost just by basically having a line that had been open for a lot longer than any of mine had. So that's one trick that can have a pretty immediate, that happened within 30 days for me. So your payment history is a huge part of your credit score as well, meaning pay your bills on time. That's your late report on your credit report in 30, 60, 90-day increments. And those late, it's about 7 years for them to fall off. So they might not continue, like say you had a late, something happened, 30-day late, probably not going to be a huge deal. But if they see that it's consistent, that will have a negative effect on your score.
Yeah, I have a question about
Correct.
that.
Mm-hmm.
They also look at your PG&E bills and water bills on that, don't they? Or no? No.
You can, it's called non-traditional credit, but they have some self-reported. So sometimes when people are trying to build their credit up, meaning, because also in the home loan process, if you have no credit score, meaning you have no debt, that's also, you need a score in order to get a home loan, essentially. There are some programs, like say you have a co-borrower who had, there's some weird instances, but in most cases, you need a credit score because essentially they're giving you a loan. They want to make sure that your credit score is essentially a way of seeing like how have you dealt with debt in the past. And so if you're hoping to build your score up, I think there's self-reported things you can do. where you take your bills that you pay every month, cell phone, PG&E, insurance, things, and you can sign up to have those report to the credit bureaus, and so that can help to build up your credit. But again, I have never seen a score that we didn't find a path forward to improving. Sometimes it's time, sometimes it may take a few months. And so another reason that, in my opinion, is like get this process started early, because say your credit is not quite where you want it to be. There are kind of buckets for credits for what you qualify for. So say you qualify for the loan, but you kind of want to get to the next bucket for pricing or for a different loan product. For instance, like down payment assistance programs, they're great programs, but some of them require a little bit of a higher credit score. So say you qualify for an FHA loan with a 580 credit score, there's some down payment assistance where you need a 680 to qualify for that program. So sometimes we'll just look at, maybe you just need a little bump, and it can be as easy as like, hey, pay this card down $100. But I have a program that allows me to put your credit report into it and kind of find a path that tells me kind of exactly what to do to get your score up. So
That's good.
can be helpful.
Make the plan.
This next slide it's really just to demonstrate a little bit how many loan programs there are out there. The four, they're called conforming loans. They're probably the most common, what people know the most, but FHA, VA, conventional, and USDA. But there's a whole world of loans out there that they'll call non-QM or non-qualified mortgages. A lot of these are like an investor loan, or a bank statement loan is most common for self-employed borrowers. There's just a ton of options out there, as well as down payment assistance. We have California specifically has some great down payment assistance programs. It's for a lot of people, down payment, saving up that money is the barrier to entry. Meaning you want to buy a home, but it's hard to save money. And so having that boost, having a down payment assistance that can come in and help you with that down payment, for a lot of people is what they need to get them into a home. So some great programs out there. With the conforming loans, FHA for down payments, it's a 3.5%, as little as. Conventional, if you're a first-time home buyer, it's as little as 3%. And then VA and USDA are 100% financing, meaning they're zero. You can come in with 0% down. So I'd say those are the most common.
How often are you considered a first-time home buyer after how many years?
Yeah, so you're considered a first-time home buyer if you've never owned a home. You're also considered a first-time home buyer if you haven't owned a home in the last 3 years. So you can get first-time homebuyer benefits more than once if you wait. And the main benefit of there are some people think of an FHA loan as a first-time homebuyer loan. You don't need to be a first-time homebuyer for that loan. FHA is a little more lenient on credit than a conventional loan. And I think that's kind of why. For a lot of people, the steps, they get their first home with an FHA loan, and then down the line, because having a mortgage will actually do good things for your credit. It's an installment loan, a long-term loan. So then down the line, they kind of either refinance into a conventional but it really, again, there's no such thing as one shoe fits all sizes. It really is a puzzle. Everyone's different and every situation is different. So the biggest difference, I think, FHA and conventional is for mortgage insurance. Mortgage insurance for a conventional loan is kind of based on you as a borrower. So it looks at your credit score. It looks at what type of house. Is it a 1 unit? Is it a 2, 3, 4 unit? It looks at the debt to income ratio. It looks at kind of you as a borrower, and then kind of evaluates that on risk. And then that's how much your mortgage insurance is based off of. For a FHA loan, it's just a flat, it's 0.55% of the loan amount. So sometimes if say your credit is like low 600s, it's like you definitely qualify for a loan, but conventional, your mortgage insurance is going to be $500 a month. Whereas FHA, it would be maybe $100 a month. That might be a really big reason that an FHA loan would make more sense for you because one, you're qualified for more with an FHA loan, um, and two, $500 a month for mortgage insurance just is not very. It's not something that I would recommend for most people. That's a huge expense, $500 a month. So it's one of the things we look at when finding out what loan product is for you. But there's, like I said, there's so many loan products out there. So oh, and for this, so once we look at for the pre-approval process, we look at, I call them my four most important things, but it's the home itself. Do you need a certain amount of bedrooms? Do you want to be in a certain neighborhood? Do you have a certain purchase price? So that's my one most important thing. The second most important thing is your monthly mortgage payment. And like I can help you into any kind of loan you want, but at the end of the day, you're paying this mortgage payment every month. Making sure that that's a comfortable payment and it fits into your budget is a really important part of the pre-approval process. Because say you qualify for $1 million home, but every month that payment's not comfortable, that wouldn't be a good financial decision. That's so something to think about. Because kind of going back to that debt to income ratio and what you mentioned about like, yeah, PG&E and garbage and these things, all these bills we have, we don't have to count those in your debt to income ratio. And so, but we do want to keep those in mind. Like, it's not realistic to think that your only things that you have to budget for appear in your credit report because we have lives. We need to eat, we need groceries, we need gas for a car. If you have kids, kids are expensive. Like, there are things that come along with life. And so, this investment, it's a big investment. It's for most people a really lucrative investment over time, but it is just one piece of your financial picture. So making sure that it works for you in your budget and for your goals is really important.
Logan,
The next most important thing is going to be interest rate. Yes.
Logan, will you remove the little blue box?
Oh, shoot.
Yeah, just so we can read it. Okay, that's it. You're doing
Um,
great. This is awesome.
and so interest rate is another mortgage interest rates are a little bit different than, so say you go to buy a car, they look at your credit and they say you get this rate. For mortgage interest rates, you can get whatever rate you want. You just pay up front for that rate in the form of discount points, what they're called. And so I always tell people, like, say you see a company and they're like, we can get you a 3.99 rate, but everyone else is in the sixes. It should raise a little red flag because they can get you a 3.99 rate, but they're going to charge you a bunch of money to get that rate. And sometimes they're a little sneaky about it. Like, they can get you that rate, but then they have a really large origination fee or something like that. And so just something to think about, but that can play a role in, say you want your monthly payment to be, you're very specific about where you want your monthly payment to be, then maybe it makes sense to buy down your rate a little bit to save on your monthly payment. So my most important things are the most important because they're essentially in this process, they're the puzzle pieces that we can adjust to make sure overall it's a good situation. Because the last most important thing is going to be your cash to close. So how much money are you bringing this transaction? And so all of those puzzle pieces, we'll find a way to put them together so that it's a good situation for you,
Can
because
I
they
add
all kind of
something?
influence each other.
Can
Mm-hmm.
you hear me?
Yeah.
Okay. Just talking about seller credits, and I have a home right now. The owner is offering up to $10,000 seller credit. So that can help pay for buyer's closing costs, insurance, taxes, or it could pay for maybe new flooring or other things in the home. It just kind of depends on what's most important to the buyer. Like Logan said, if you need money to close the deal, sometimes we can get that from the seller in the offer by what's called a seller credit. And my seller on 1321 Silverado just added up to $10,000 seller credit. So people should be looking into that. What
And
what did you
seller
lose,
credits are
Gerald?
they're a huge thing right now, as we've kind of
Mm,
shifted, the market has softened, is what they say, but we've shifted into a bit of a buyer's market. And so one huge benefit to that is that we're seeing seller credits. Like if the market is super duper competitive, they're most likely, if you have an offer and you're asking for a seller credit, the seller might go for another offer. But in this market where we've kind of shifted into the buyer's market, we're seeing a lot of deals that are getting a seller credit accepted. And what it is essentially you say Bridget's selling her home for $400,000. That's the asking price. I want to buy her home, but I don't have quite enough money to cover all of my closing costs. So in my offer to Bridget, I would say, "Hey, I'll pay you $400,000, but I want a seller's credit. I want you to credit me $10,000 back." And it's not in the form of cash, it's back to the transaction, so it will cover my closing costs, and it doesn't come out of her pocket. Like it's not like she walks into the office and gives me $10,000. It will come out of her net proceeds from the transaction. So it's kind of a way for the buyer and the seller to work together to make the deal work a lot of times. And sometimes it can be for that reason, like say me as a buyer, I just don't have enough to cover the closing costs, so I need a seller credit for that to happen. Or it can be in the form of like, hey, your roof needs to be replaced in 3 years. I know that expense is coming and I don't want to cover it all. I want you to give me a seller credit so that down the line when that, and so it just depends on where the seller is. If they're flexible, like obviously Bridget's seller says, you know what, I think this will incentivize someone. I'm ready to sell my house. I'm going to offer a $10,000 credit off the bat. So it kind of comes in a lot of forms, but it's money to cover parts of the transaction. But you could use that to buy down your interest rate to get a lower monthly payment.
right. And because the buyer's going to have to pay for the inspections and things, it's going to be less money that the buyer, has to bring in to close. So you keep your money in your savings account. The seller credits you money through the transaction so that basically you don't have to bring as much to closing, if any. I've had a client bring zero to the closing table and they got their keys because they had a down payment assistance and we had a seller credit. It was amazing. They brought in
Mm-hmm.
no money and then they got keys to a home. Incredible. So lots of options.
And there's a lot of people talk about interest rates. They're obviously a few years ago during COVID, interest rates were in the twos or threes, and they're not anymore. And for a lot of people, that's like I hear all the time, why would anyone buy a house right now? Rates are high. But for me, now's the perfect time to buy a house because of that competition reason. Like people remember the 2 and the 3% rates, but they don't really remember that every house was getting multiple offers. Almost all homes were going for over asking. We had a house locally that went for $100,000 over asking, which what that does as a buyer is it really limits your, like I had a client who put in 7 offers before they had one accepted. And that as a buyer it takes its emotional toll because every time you put an offer in your house, you're not doing it on a whim. You're picturing your life in that house. You're picturing your family. You're picturing your future. It's like I said, this is an emotional thing. And so right now in a buyer's market, it's just the competition's not there. And so what we're seeing is more offers accepted, seller credit, and it's a silly thing that we say, but I say marry the house and date the rate because you could always refinance into a lower rate, but once rates go down and all these people come off the sidelines, home prices are going to go up because the competition is going to come back. So I think now's a perfect time to buy a house. But kind of going back, my next slide is just what makes up your monthly mortgage payment because you will pay this every month, and it's when we discuss loans, it's obviously there's different terms, there's different loans. I would say a majority or most common is the 30-year fixed rate loan, meaning you're from the day you sign the papers, if you choose, you can have that same payment for the next 30 years. However, the fixed part of it is your principal and interest, meaning that the amount of principal and the amount of interest will change, but the overall amount you're signing up for that for the next 30 years if you choose. Kind of again going back to our grandparents, the idea that you will move into your first home and have that loan for 30 years is kind of more of our grandparents' generation. For most people, your first home is not your forever home. Your first home is kind of, it gets your foot into the door, it allows you to start saving. And then down the line, say 5-10 years, you can take the equity that you've built up in that home and then turn around and use that as a down payment on maybe something that's more your forever home. Another crazy statistic is the average mortgage is 7 to 8 years. So you signed up for a 30-year, but that means within that set, and again, it's an average like there are, but you either refinanced or you sold or so very, very few people stay in their mortgage for that full 30-year term. But that principal and interest portion of it will not change over the term of your loan. Also in your monthly mortgage payment are your taxes and your home insurance. And if you put less than 20% down, you will also have mortgage insurance on there. Property taxes here in Humboldt County, a good estimation is 1.25% of the purchase price. And for homeowners insurance, it's been a little bit of a wild card in California this last year. We have seen home insurance go up. It is still, I heard the other day, someone asked me, oh, you live in California, how can you even get home insurance? Which is not true. There's very much a home insurance here. But that most likely will continue to go up over time is how. There's a cap on how much they can raise it each year, but historically what we've seen is that gets more expensive over time. So, and then mortgage insurance, if you put that less than 20% down, on an FHA loan, mortgage insurance is on there for the life of the loan. But on a conventional loan, it falls off, meaning once you hit that kind of 20%, 78%, the mortgage insurance just falls off. So you don't have to pay that for the whole term. So, but those are what make up your mortgage payment. And then that's kind of it. I know that the home loan, there's a lot to it. There's a lot of information. I joke that there's no question too small. If I don't talk to people about home loans, then I go home and I chat my boyfriend's ear off. So I really do love talking about this stuff. So my phone number's there, but feel free to reach out with any questions. And then kind of going back to, people ask me all the time, like, when is the best time to buy a home, or when should I buy a home, or when do I get ready? And it's really, there's no black and white answer out there. The best time to buy a home is when you're ready.
Mm-hmm. Yeah.
But getting the process started and seeing where you're at, in my mind, there's no downside to that. Ignorance is not bliss when it comes to our finances. So why not and for a lot of people, I think it's intimidating and it's something you kind of put off. So why not take a look at it, see where you are. If it's not today, let's make a plan for tomorrow, or let's make a plan for in a year, because finding these things out and where you want to be is such an easier path. If we can find your goals and kind of wrap some numbers around that, it's so much easier to do that than to think like, oh, one day I want to buy a house. Like, let's make that goal attainable. Let's define it. Let's find steps to get there. And that's where Brigitte and I come in.
I love it. I always tell people it's your journey, it's not mine, and it is a journey. So starting to just start the conversation is just what you need to do if you want to buy in 5 years from now. Good tip to ask someone to make us authorized user. Yeah. Do you guys have any other questions that you can think of? If not, send us your questions.
No questions so far. Thank you for all the information. We were paying attention here.
Great. Thank you.
I would say the one thing about authorized user is that you do want to make sure that it's someone with a card in good standing, because just like you can pick
Yes.
up all the good parts, if you can pick up all the bad parts too. So
Yeah.
make sure that a responsible credit owner.
That's good. And I'll have it recorded. I'll post it to my YouTube channel if, you guys want to watch back and watch it again. It's a lot of information, but yeah, you know who we are. We're on Instagram, and just thank you so much for watching. I'll be doing two more classes. The next class will be going over the purchase agreement in detail and what we do when we make an offer. So, yeah, tell your friends. And thank you so much for being here. Thank you so much, Logan.
Yeah, thanks for joining us.
All right, well, I will stop the recording and until next time.